Every year, listed companies publish their numbers: earnings per share, dividend yields, price-to-earnings ratios. But here is the uncomfortable question: does anyone actually trade on them? A new study went looking for the answer in one of Africa's smaller stock markets using 13 years of data. The Dar es Salaam Stock Exchange opened for trading in 1998 and welcomed foreign investors in 2002. By 2024, it hosted 28 listed companies. By global standards, it remains small, with modest market capitalization, a thin index, and low trading volume. It does not appear in the major global market indices. That makes it an interesting test case, because most research on whether accounting information matters has been done in large, mature markets. The study is built on signaling theory. Managers know more about their company than outside investors do. Published financial figures are the signals that close that gap. If investors trust and understand those signals, the numbers should show up in prices, in the index, and in how much stock changes hands. Here is how they did it. From 28 listed firms, 16 qualified, companies with a track record of active trading across the study window. 7 from the financial sector, 6 from manufacturing, 3 from other industries. Data ran from 2010 to 2022, drawn from the exchange itself, the Bank of Tanzania, the National Statistics Bureau, and audited annual reports. Because stock markets carry momentum from one year to the next, ordinary regression was not enough. The team used a dynamic panel method called System GMM, which accounts for that persistence and for reverse causality, then ran validity checks on the model. First result: market capitalization. Only one variable moved the needle. Dividend yield had a positive and statistically significant effect. Earnings per share and the price-to-earnings ratio did not. In this market, a company paying a reliable dividend signals stable cash flow, and that attracts capital. Reported profit alone does not. Second result: the market index. Here, the past dominates the present. Last year's index level was by far the strongest predictor of this year's. Earnings per share showed only a weak effect, and the other measures showed none at all. In other words, broad macroeconomic forces and investor sentiment appear to drive the index more than any individual company's fundamentals. Third result: trading volume. This is where accounting information finally bites. Both earnings per share and dividend yield significantly increased trading activity. Investors do react to profit announcements and dividend news when deciding whether to buy or sell. The price-to-earnings ratio once again showed no effect, which the authors link to limited financial literacy and very little analyst coverage in this market. Taken one at a time, the indicators were inconsistent, but the study's real contribution was testing them together. Joint statistical tests confirmed that value relevance as a package has a significant positive relationship with all 3 measures of market performance. The signals do get through, just unevenly. The practical takeaway is direct. Regulators should enforce disclosure rules more firmly, and listed firms should publish dividend policies and earnings announcements promptly. Better signals mean more participation, and more participation means a healthier market. Accounting numbers are not just compliance paperwork. In a developing market, they are the currency of trust.